Are you planning for tax-free income in the future using a Roth IRA? Let's think again, because there is a better way. Let's talk about why we use a Roth IRA to begin with. This type of asset is tax-free or tax-exempt, meaning that you put the money in and then you don't pay tax again. So the money is going to grow tax-free and you'll be able to use it in the future tax-free. Sounds amazing, right? This is in contrast to two other types of tax treatment that can be on your assets. Now, one is taxable accounts, and in a taxable account, you pay tax on the money before you put it into the account, like a tax-free account. However, every time that money grows, you have to put that year's growth on your tax return and pay taxes. Might be easy enough in the early years, but as that account grows over time and your growth increases, you can have a tremendous tax bill that you're looking at as your accounts grow. So that's why tax-free accounts are better than taxable accounts. What's the third option? Tax-deferred. Now this has become very popular, but has significant limits as well. Now, if you put money into a tax-deferred vehicle, you actually defer the tax today, so you do not pay tax on that money today. This decreases your current year's taxable income. This could actually save you money in taxes today. However, it's not really a savings if that's still trailing behind you like a ball and chain, and you're going to get to the future at some point when you're going to have to pay the piper. So what happens in a tax-deferred account, you're postponing tax until the future. And what happens in the future is that tax is going to be calculated based on the current year's tax rate at that time and the current tax bracket. So basically, you have no idea how much tax is going to be due, and therefore using tax-deferred accounts cause a lot of uncertainty for the future. So again, back to the Roth IRA. This is tax-free. That's good. However, there's three significant limits. One is that you have limits on your access and control. What do I mean by that? Well, first of all, the money is not a guaranteed set value. It could fluctuate up and down with the stock market, leaving you with less than you expected and decreasing that future income. You can access up to the principal, what you've put in, but not the growth, unless you want to pay those IRS taxes and penalties. So it has limits on control and access. Secondly, there's limits on how much you can put in. So these are called contribution limits, and they typically rise a little bit each year. And in 2019, the contribution limit on a Roth IRA is $6,000 per year. If you're over 50, you can add an additional $1,000 with the catch-up contribution, making that $7,000. But think about this. What if you wanted to put $20,000 aside? What if you wanted to put $200,000 aside? You could not do that in a Roth IRA. And if you think about the volume of $6,000 per year on average, even if you put that money in over 40 years, you're not going to get anywhere near enough money to be able to withdraw the interest, preserve the principal, and live well in your future. Even if you withdrew the full principal and drained the account completely in the future, it's not going to live up to the expectation of creating the same standard of living that you have today. Which brings us to the third and most important limit of the Roth IRA. Many people simply make too much money to even contribute in the first place. Now, if you're a family and you're married filing jointly, if you make more than $203,000 per year, you cannot contribute to a Roth IRA at all. You just can't. And if you make over $193,000, your limit, the amount you can put in, it's lessened. It's called a phase out. Now, if you're single, you can't make more than $137,000 per year. And the phase out starts at $122,000, meaning you cannot make the full contribution. So this really is not a strategy that works if you're a high income earner and you're trying to create an amazing lifestyle in the future that matches your standards today or is even greater. So what do we do instead? There's another tool that we can use for tax planning for the ultra wealthy, but it works for everyone just the same. This is called a rich person's Roth. That's right. Now, what is a rich person's Roth? This is a place where you can put money tax-free or tax-exempt. You're putting money in today, you've paid tax on the input, then you're never paying tax again on the growth. You don't pay tax when you use the money. And there is no limit to your access. You also don't have any income limit where if you make too much, you can't put anything in. So what is a rich person Roth? Well, you might have also heard it referred to as a richer man's Roth or as a cash flow banking policy or as a specially designed life insurance policy. We're actually talking about a life insurance contract. And yes, it is IRA sanctioned to perform the same way as a Roth IRA, where you pay tax on the money that you put in premiums, and then the money grows tax deferred, where you don't have to pay tax on the growth, and you're able to use that money tax-free. Now again, there's no limits to how much you can put in, and there's no maximum income. So we remove all of the boundaries, so we remove all the limits and frustrations of the Roth IRA. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below, and don't forget to hit subscribe to our YouTube channel.